afternoon. My name is Simon Catt from Catt Calls and Arlington. I'd like to thank my co-host Peter Gadsden and miningnetwork.co.uk. We're coming live from a warm London afternoon. It's been warm all week for the start of Wimbledon here. And in fact, it's so warm that the London Underground has broken down again, and Ned Naylor-Leyland from Jupiter will join us in about 15 minutes. He's had to resort to an Uber to get to his place where his computer is to join us. In any case, the format here is I'm going to introduce our esteemed presenters on the Trump versus gold panel discussion. They're going to tell us about themselves and what they think about the Trump administration's effect on the outlook for gold. And then we're going to get into a panel discussion and ask you, the audience, for any specific burning questions or issues that you would like to have this audience of extremely experienced commentators and thinkers on gold and precious metals. First of all, I'm going to introduce Robert Gottlieb. Robert has been the managing director of two of the largest bullion banks in the world. He's writing a book about the gold and silver market. Robert, can you tell us a bit about yourself and what you think about Trump versus gold and the impact on the gold market and its outlook?
Thanks, Simon. Looking forward to today. I am retired as of last October, and I spent the last 30 years in the bullion banking business. MDs at major banks such as JP Morgan and HSBC. So I've eaten and breathed precious metals for 35 plus years. And Trump is great for gold. And the main reason is the word uncertainty. And we have tremendous uncertainty in these markets today based on geopolitical and economic uncertainty. Obviously, the policies that are coming out from the US are flip-flopping. Also, many of the countries are afraid of what we're going to do. Obviously, tariff situations make the market extremely nervous. And I believe that gold has become the ultimate safe haven asset in the last 2 years, evidenced by all the central banks buying gold. 17% of whatever's been produced in this world is held by central banks. The last 4 years, over 1,000 tons have been purchased versus 450 tons the 7 years prior. So there's a concerted effort by central banks to diversify themselves away from the dollar, and they're using gold.
Thank you, Robert. Charlie Morris, if I could ask you to introduce yourself next. You are the founder of an organization named ByteTree. You manage a gold and Bitcoin ETF named BOLD. And you've been writing Atlas Pulse, a newsletter about precious metals and other interesting things for over a decade now. Charlie, what do you think about Trump versus gold? And is there anything else that I've missed that's important to say about your background?
No, that'll do. I've done lots of things in my life, but I won't bore you right now. The Trump and gold, I think, Robert said it most of it, but I'll just add the obvious, which is, money creation, dollar down, instinct for lower interest rates, not particularly concerned about inflation if that results. If we have the low inflation, if we have the low interest rates, will that result in inflation? Probably. And so, put all those things together and it's a case for gold. And one of the charts I created in the last few years, when we moved away from the relationship with 20-year tips, which was so close until about 2021, and then we moved away to a new regime in gold. And I always said that there's a sort of bond sitting inside the gold price. And so I did a chart where you stripped out the 10-year bond yield and or the 10-year bond price. And by God, it's just a straight bull market. It's gold squared. And so, is gold replacing bonds in some kind of capacity? I think so.
Interesting. So, meaning gold is replacing US Treasuries as the world's risk-free asset.
Yes, I mean it's got a way to go, but I think that trend is in motion.
Very good. Thank you for those brief words, Charlie. We'll come back to those subjects. The next gentleman I'd like to introduce is Peter Kraut, author of The Great Silver Bull, editor of Silver Stock Investor. Peter, thanks for joining us. What are your thoughts on the Trump administration's impact on the outlook for gold and silver?
Simon, thanks for having me. And your previous guests have mentioned many of the things that I would have said as well. So I'm certainly in agreement with pretty much everything that they've said. I will probably just repeat. I think that inflation will become a bigger issue. I think we're going to see an analog to the 70s where we had these multiple waves of inflation, where I think we're in a lull actually right now. I think the second half of this year, we're going to start to see, as we did in the 70s, a new rise in inflation. I think that central banks will have no choice. They will start cutting. And then when the markets grasp that central banks, have lost or caved in this game of chicken, where they've said, we really don't have a choice now. We are, they've got to they've got to choose between trying to fight inflation or supporting the economy. They'll err on the side of supporting the economy, cut. And when you see them cutting in the face of high inflation, and you're back into negative real rates in a marked way, that's it, game over. And I think that that's when you'll start to see a lot more piling into gold. Certainly, on all of this, Trump is very supportive. He wants lower rates. He's about to appoint likely a new Fed chair. We'll see how compliant somebody like that is. But to Charlie's point about whether gold is starting to replace treasuries as a preferred asset, if you look at there's an interesting stat that came out just recently, and that is that gold has now surpassed the euro for central bank holdings, in terms of the percentage value. So it's probably going to be a long way before it surpasses the dollar. But I think the end game is actually that there's going to be, at some point, it could take a while to play out. Who knows, 10 years, 15 maybe, where gold ultimately becomes or has some sort of role globally in terms of the financial system and backing currencies. So impossible to know what form that will take, but I think that's where we're headed.
Interesting. Thank you, Peter. And that brings a whole bunch of other questions and issues to mind. While you were speaking, I see that Ned Naylor-Leyland has joined, the Jupiter Gold and Silver Fund manager. Ned, can you hear us?
I can, Simon. Hi. Sorry. I've been enjoying the delights of a steaming hot and collapsing Transport for London network. I will be visible shortly, but currently I'm still sort of in transit. But I was enjoying listening to Peter there.
You're probably a bit hot and sweaty, so you might have a towel off before we see your face.
Yes, I will do that.
And then
Go on.
apart from running the Jupiter Gold and Silver Fund, a billion or two, any other background about yourself that we should know about and think about the relevance to today's title of the webinar, Trump versus Gold?
Well, not really. I mean, I think we all sort of wonder whether we're really appropriate to have comments on any of this at all, Simon. But I suppose I've been writing, or I used to write more often, 10, 15 years ago, about these kinds of topics, about the reintroduction of gold and how price discovery works, that kind of thing. So I've got a deep interest in it. I do think that the thing that Besant said in the White House in February, when he talked about monetizing the asset side of the US balance sheet, I think this is very important and interesting. And the way I read it is that potentially it's a kind of two-card trick of, in line with global best practice, as he stated in the White House, allowing US gold reserves to be marked to market. And then once that happens, that puts the US on the same level playing field with other central banks and governments, at which point then potentially you might see this visit to Fort Knox. Arguably Fort Knox was drained 30, 40 years ago and the gold went to West Point, and that's certainly what people think. So I see all of this as being quite interesting. Obviously, we have to speculate to get ourselves to a position where we can make sense of it all. But I'm happy and delighted and look forward to digging into it more.
Very good. Well, look, we'll get you let you get home, Ned, and look forward to picking it up once you've towed off. Thanks to London transport. Um, maybe returning to the other panelists while Ned gets home. A question for you, maybe a controversial one. I recall that maybe with some similar parallel times, when Roosevelt came to power, he had the New Deal. He confiscated private ownership, made it illegal for private investors in the United States to own gold. Is that something that could happen again? Any of the panelists, feel free to jump in there.
I think it's unlikely. And the reason I say that is because gold had an official role in the system then, and now it doesn't have an official role. And you could say the same about Bitcoin and other things. So I think that's really, really important difference. And so when it had an official role and there was a peg and that sort of thing, then the state felt it was theirs. And this time they just see it as a private asset. So, I think we need to go back onto a gold standard for that to be a concern.
And and in terms of reflecting on Trump investment's comments about monetizing the US balance sheet, is that about the Fort Knox gold or about private ownership or anything else, Charlie?
I'm not sure. I don't think anyone's made it very clear what they actually mean here, apart from the revaluation of some kind. But I don't really understand. I mean, I personally am a bit of an outlier in gold bug circles because I actually think the gold price is a free market price. It's set by a free market, and it's 3,300, and that's that. And I don't believe that there's price suppression. I'm sure brokers, play cat and mouse with one another and with their clients. But and that's there's some price suppression there. But I honestly think that the gold price is what it is in a free capital market, and I don't see how they can make that 10 times higher at the stroke of a pen.
Gotcha. Robert, what do you think?
Yeah, I think obviously it's clear gimmick putting most central banks keep their gold reserves at historic value. I think ours is at 35. Others are a little higher. And if we put out gold to 3,300 plus, obviously our president could come out and say, hey, look how much money I've made for the country, when the fact is it was just marking to market. That's the only way I see us ever putting our assets to market. It's just for him to say exactly that look how much money I've made for the country. Our balance sheet is worth X. But the fact is that I think that would be a pretty negative outlook for the dollar right now, and I don't think that we would end up doing it.
Yeah, I find it personally hard to imagine why. If we mark the US gold to market, I believe it's worth in the order of $1 trillion, which doesn't sound like a lot compared to 35 trillion of US government debt. Peter, what do you think?
Well, not a whole lot more than your guests before me. The one thing I would say is that I guess somewhat related to this is this whole idea that Trump has said that he's going to go back and they're going to audit Fort Knox. And when he was president the last time with I think it was Mnuchin who was Secretary of the Treasury. Apparently Mnuchin went and looked and everything was there. Right. At least that was the message that we got. I wonder about sending somebody in this time and getting a different message. It's always easy to point because the Democrats were there after him. So if the gold disappeared, maybe it disappeared while the Democrats were there, right? So so again, there's always an easy way out. But given that that took place under his his watch, I'm just doubtful that we'll actually see this visit to Fort Knox and what the outcome might be. Really, that's all I have to add to what was said so far.
Gotcha. Thank you all. What about China? How important is China? What is their monetary endgame? What does that mean for the gold price and maybe the silver price while we're at it?
I mean, that's a huge question, and a very important point. I believe China's endgame is much bigger than anybody thinks. I believe that they are trying to establish gold. First of all, China is the biggest producer of gold and also the biggest demand for gold. So they're massive when it comes to the country in relation to gold. However, they don't have up until today, they don't have an impact on the international price. The international price is traded in London and New York for most part. It's traded in Asia, but more on the local London price. I believe that China is doing several things, not just to bolster the price, but for them to become an international market, meaning that Gold's hub will be New York, London, and China. In addition to that, I think that they're trying to bolster the renminbi by fostering more involvement in gold. If we take a look, the SGE and the SHFE have changed policies tremendously. The SGE just opened up 2 contracts in Hong Kong. You can trade it based on the yuan, not in the dollar. They've also opened up an independent vault there. They're discussing a vault possibly in London and in Dubai. In addition to that, we've seen China give permission to the top 10 insurance companies to buy 1% of gold in AUM. That, according to World Gold Council, is $27 billion possibly, and that's the pilot program. In addition to that, you can now trade domestically in gold, which was prevented before. So I believe, and then, sorry, on top of that, they just came out with a new piece on mine development, trying to increase the #1 production even further. So I believe that China isn't just fostering gold, but I think they're trying to become an international hub. And the other thing is, I think that they want the world to supplant the dollar with gold. And then that would bolster the renminbi. And just one more comment related to Charlie and interest rates. I think what's different with gold today than has in the past is that gold traditionally goes up with a weaker dollar. And today we're seeing that when there's a weaker dollar, the Western central banks are coming in and buying gold. However, with a stronger dollar, we're seeing China come in and buy gold. Why? Because they're hedging the renminbi, and there are not many alternative financial assets that would do the trick. So I think that gold has become what I call the ultimate safe haven asset and currency. And
Well, it all sounds pretty relevant, Robert. Thank you. Peter, what do you think?
I don't have a lot to add to what Robert said. I mean, I agree with it. It makes sense that these are all things I would be saying as well. And I do think that, as he mentioned, it's difficult for us to know to get inside, their mindset. But I do believe that they want to be a meaningful global participant, not only participant, but player in the gold market, and that it would in fact bolster their currency. What I did want to mention, this goes back to one of our prior points when we talked about central banks buying gold. So one is, as I think probably most of your guests would agree, the Chinese central bank is very opaque when it comes to the amount of gold that they buy. And the other thing is, so, who knows, they may have 5-10 times what they're currently saying. The other thing is that if I looked at when we saw for the last, what was it, 2 or 3 years? The last 3 years, central banks around the world were buying north of 1,000 tons of gold a year. When I saw that the first year, I thought to myself, let's just do a quick calculation. That meant that it was 1 out of every 4 ounces of gold was being bought by a central bank. That is just so meaningful in terms of their demand versus the rest of the world's demand, right? The non-central bank demand, that I thought, if you're ignoring what the central banks are doing, you're completely missing the picture here. And so those are my thoughts.
Very good. Charlie, before I ask the clean-shaven Ned, any thoughts on what China's monetary endgame is?
I think that they want to be independent. I think they want to live in a world that they don't need the US to be their friend, and they don't need the dollar to be a part of their system. So
Mm.
I think they're just seeking independence, and one cornerstone of that is to have high quality, pristine reserves, and lots of them, and that's why they're buying gold.
Gotcha. Ned, welcome back. Might I say you're looking very sharp this afternoon, despite your journey. Ned, the question is, what is China's monetary endgame?
Well, look, I think that that what's going on is the central banks understand that gold is risk-free and treasuries aren't. They've known that all along. And that we're returning to the pre-1971 world. There's nothing new in that. I don't think that China has any interest in being a global reserve currency or anything like that. They want to ideally to clear international trade imbalances using gold, which is the historic norm, the mercantilist norm. I think China's role in this is overstated, if I'm really honest. I don't think that that's so important. I think that the stuff that while I was in the taxi and non-visible, listening to my friend Charlie, poo-pooing the idea of gold suppression, which I find quite funny, is more relevant to the conversation today. I mean, on the basis that governments and central banks have always propped up their currency versus the risk-free, the idea that's not happening now is, let's say, somewhat unrealistic. Apart from anything else, institutions such as JP, not to throw shade on Robert, having been fined under RICO legislation of $1 billion for fiddling in the market, suggests that there are things that go on. But I don't think that that's what matters. What matters here is more simple, which is if the US government do go to Fort Knox and shine a light in there, and they find that things are not as they should be. And I would tend to suggest that that's the only outcome that's likely, because otherwise, why on earth is he talking about it? Why would you talk about going to do that? If you were really worried about it, you would just go do that. You're not gonna do that unless there's an end game here. And the end game is to reveal to the financial participants in gold, and central banks are not financial participants. They hold their gold themselves, or most of them do now, is to point out the difference between pristine collateral, which central banks have, and the type of gold that financial investors hold, which is almost never the real physical gold. Now, we don't get good information from the LBMA. It's very, very limited, and there have been very brief moments where we've seen under the skirt. We're talking hundreds of billions of dollars of over-the-counter turnover every day. The ECB themselves, 2 to 3 weeks ago, put out a research note talking about systemic risk for the entire financial system if people seek delivery of their gold. That is not my opinion. That's now on record that that's the case. So clearly there is a situation whereby if people are incentivized to say, well, where is my gold? Where's it being stored? Who has it? That could definitely create a change to the price environment. And for me, I think that that's very interesting because central banks hold gold as their principal reserve asset. That's the left-hand side of their balance sheet. That's the thing that can resolve the right-hand side. And the right-hand side is, let's say, very, very bad now. So bad that the need to improve the left-hand side is much greater than it has been previously.
Yep.
Simon, can I just chime in for a sec?
Please do, Peter.
To follow on Ned's comments, I've just been reading the last week or so how there's a big push by Germany and Italy to repatriate their gold that lies in New York, London, and elsewhere. And if I have this right, after the US official numbers, they're number 2 and number 3 in terms of gold holdings. So that sounds like it could be pretty significant and start to get other, let's say, whole or gold holders who are storing outside of their borders to start to get perhaps worried as well.
For sure. Yeah, I think you think not just US treasuries in terms of the Russian experience after Ukraine, but also actually getting your reserves, your gold reserves home is potentially prudent because of that sovereign risk.
And given the delays that it took the last time we saw this this sort of scenario play out, you really have to wonder where the gold actually is and who and how many claims there are on it. It just doesn't seem normal that it could have taken so long to get these deliveries, complete.
Yeah.
When
Does
you're
anyone
talking
have a
about,
view? Sorry.
when you're talking about deliveries, are you talking about the Bank of England problem?
Yes.
Yeah, the problem actually with Bank of England, and I think I've written about this extensively, is that Bank of England is not a commercial vault. I actually spoke to the CEO of the LBMA. I spoke to the chairman of the LBMA. I wrote to Bank of England. The issue is Bank of England, if you're storing 80 bars, which is 1 ton of gold, it could be in 80 different locations within the vault. It's just impossible for them to operate as a commercial vault because all the holdings are scattered and there's no resolution. They're just happy that the tariffs went away and therefore the bottleneck went away. But we are going to face this issue on the next dislocation. You never could say what the dislocation is. I couldn't tell you it was COVID-19 or tariffs, but we will face this issue. But it's because they're not a commercial vault, and that's why we went to 2-month queues.
So, Robert, can I just ask you to clarify what I think you meant? You're talking about the difficulty for the Bank of England and maybe other bullion banks or central banks in delivering gold, that it is too dispersed and difficult to actually find underground in the vault. Is that what you just said?
Yeah. So you have basically the London market is traded on an unallocated basis at the major bullion banks. The difference between gold and silver, though, is when we had these big dislocations with tariffs and COVID-19, is there's a lender of last resort for gold, which is the central banks. While there is no place to go for silver. So when the banks needed the gold to ship the gold to close their arbitrage, say, for instance, from London to the CME, they went and borrowed gold from central banks. What we have to understand is that 17% of whatever has been produced in the world is held by central banks. So there's no scarcity of physical gold. What there is, though, is the ability to get that. Once the borrowing started, there was an onslaught of borrowing, and the central banks, obviously, lease rates went to 2% when they were 20 basis points for 10 years. So they wanted to lend it out, except for, as I described, their vault they stored at Bank of England, and Bank of England wasn't able to physically comply with this. And this will happen again on the next dislocation.
So can I just ask, Simon, if I may just ask Richard a question? Richard, what about, let's say, I can't remember exactly the timing, but it must have been about 10 years or so ago. There was this wave by central banks to repatriate their gold. Some of it came from the US, it wasn't from England. And that took a long time. Do you have some thoughts around, the reasons for those delays?
Well, it's physical. So, I mean, it's not like you watch those Brinks robbery movies and, they're picking up a ton of gold. That's not happening. So I think, though, the Fed probably operates a little better than the BOE, but the Bank of England is the main thrust for central banks around the world. But interesting enough, and I don't have it confirmed, but when Poland, who bought like 100 tons of gold since the start of the Ukraine war as they're bordering Russia, I understand they're storing the gold at the Federal Reserve because they want it as far away from Russia as possible. So that's the opposite story, but of what you're discussing. And yes, there are a lot of rumors of central banks looking to repatriate. Germany was one that did that way back when.
Exactly, and it took from memory. It took what, more a year or more for a lot of that.
4 years.
4 years ago. Thanks, Ned. I mean,
It took 4 years. It took 4 years for the Germans to get their gold back from the US. Now, that is not anything to do with they're heavy. That is a we don't have it. We're going to get it for you. This is a fractional reserve system. We're dancing around the topic here. We're talking about very obviously a fractional reserve system. It's banking. Let's be serious. Yeah, we're talking about banking. This is where banking comes from. To try and pretend this isn't the model is silly. The ECB have just stated this very clearly in a long and exhaustive research note, which concludes with, yeah, I mean, if people ask for delivery, there's a risk to the entire financial system. That's not because they made it up. That's how it works. There's no point trying to sugarcoat it. That's the situation. It doesn't matter until it does matter, and we're at the point where people are much more interested in what is risk free, where is the risk free, is it pristine collateral, has it been loan leased and swapped many times over, and the real question here is the gold that's at the Bank of England and the gold that's at the New York Fed, has it been loan leased and swapped multiple times into the system? And the answer is, of course it has. The question is, how many times, and are we ever going to get an audit of that? I think it's extremely unlikely that will happen. Frankly, I think I'll be long dead before that happens. But to try and pretend it isn't the case is silly. It's obviously the case. It's just banking.
Yeah, it was explained to me some time ago that actually it does take a long time to move gold because you fly it, you don't take it by ship anymore, and it's very heavy. So that's many different planes. Insurance comes into it and all this sort of stuff. So it takes a long time to move a large amount of gold.
But Charlie, sorry, but the Germans asked for their gold back from us to seed the euro in 1999. Yeah, they got it immediately. You know why? Because we sold our own to give it to them. So, and that didn't take 4 years. That was us and the Bank of England capitulating and going, we've got a problem here. And then suddenly they managed to get it straight away. But then the next time it takes 4 years. I mean, we can't try and lean on logistics here.
In 1999, no one cared a hoot about gold, so they were probably giving it away as scrap.
Oh, I see. So the Germans asked for the gold back. That was just they didn't care about it. It was just one of those things.
Well, in 1999, no one cared about it. The European central banks were selling it.
No, they had to post it as part of the seeding of the euro. That's how it worked. It was part of that methodology for starting the euro. You had to post gold reserves, and the Germans asked for their gold back. Just so happened that we sold, the UK sold the exact same amount at the same time. Now, it could be a big coincidence. That's possible.
I'm sure it's not.
But either way, they managed to get it back. It can't be logistics one time and then not logistics the next time. It's like saying that, London is way more complicated. It's a commercial, it's not a commercial ball. Or what about the Middle East? Ultimately, there obviously is not a situation where every bar is fully segregated and allocated and that you can just go and get it. That is not how the banking works. I mean, and particularly the role of the Bank of England in this as lender of last resort. I mean, Robert mentioned that central banks operate as lenders. I understand it's the Bank of England, not other central banks. I might have that wrong. I mean, maybe one of you two can.
I think all the central banks are in on it, aren't they? I mean, it's what they do.
They're all in on it. They're all in on it. But as I understand it, the BOE is the lender of last resort. Is that wrong, Robert?
Not the BOE that's the lender of the last resort. It's the central banks that store the gold at BOE. I could tell you, I retired in October, and I was debating on starting a consulting firm with central banks, and I met with 5 central banks within a month and a half. All they wanted to know was the BOE bottleneck and why they couldn't get, if lease rates were 2%, why banks bidding them 25 basis points. And the simple reason was because the banks couldn't get the gold, so why pay 2% if you couldn't get the physical gold out? But it's the central banks that store at the Bank of England. That's the lender of last resort. And many central banks will lend their gold even at 25 basis points, never mind 2%, because they store the gold, they hold the gold on their balance sheet at historic values. So if, for instance, gold's 3,300 today and they have it on at $35, they're making a significant amount of return today, even at 25 basis points on the mark-to-market basis.
This reveals a very important point, Robert, which is that's fine. And the Bank of England is still the custodian. They're the ones that are sat on top of these other reserves. And we know the Venezuelans got told no, we don't know who you are, we don't accept you. The Americans told the Germans you can have it at some point, gave it in 4 years. Others, as you suggest, may be able to access very quickly. This is a not a one-for-one situation. Is that not fair?
Yeah, I think, but like Charlie said, you know, despite what you said about it being heavy, the fact is it's heavy and it's expensive to insure. I don't know exactly what was shipped from the US to Germany, but it does take time. Maybe 4 years is quite unreasonable, but um, uh, uh, I think I know for a fact there are limitations on what you can ship on one plane because in the COVID-19 we moved millions of ounces from overseas into the US.
I think this would all be a lot easier to resolve if the LBMA actually gave us information about the totality of the market. And this is the great problem that we have here, which is we don't know what's going on. We don't know the OTC business. It's not available for the public to see. So, the assumptions and the conversations we're having about physical, we don't know the completely reasonable banking business that goes on, or the shenanigans, or whichever way you want to put it. Is that lack of transparency in the London market, which is a problem in terms of having total confidence that there isn't a problem.
But Ned, is any other OTC market transparent and tell you what's going on, or are they all like that?
The only market which has no information, Charlie, is the LBMA. There is no other market. That's why it's unregulated. It's a completely opaque situation. Now, we do know they did once reveal some data, and in Indian Reserve Bank produced some data, I think, without having it signed off by the powers that be elsewhere. And the OTC volume or turnover was something like $300 billion equivalent a day. That's what we're talking about, which is 20x the physical market or more. And it doesn't give confidence when you're talking about pristine collateral. The whole point of gold is it's supposed to be pristine collateral. That's why you want it. It's not about, oh, well, don't worry, we won't give you any information about it. It needs to be completely transparent, and it's not only not, it's entirely opaque.
I couldn't agree more. I mean, I put these posts out on my LinkedIn that I compared this bottleneck issue to the world today. All financial instruments are traded on a 1 and a 2 day basis, and that the Bank of England was risking gold's interest, and as far as if you can't get your gold, how deeply traded is it, despite everybody saying gold is a deeply traded asset. I agree 100% with that sentiment.
Yeah, it's deeply traded in financial terms.
Exactly.
And that's fine if you're not worried about that. But I can tell you from meeting a lot of people around the world, when you explain to people what they own, when they say, oh, I own gold, and then you suddenly find out they own XAU, and then you explain to them what that means, you get a look of absolute amazement. People are not aware of this point any more, by the way, Robert, or Charlie as well, than they are aware of regular banking. Like, people don't understand how this works. It's not a topic, despite what we went through in '08. Even the basic concept of deposit cover is not something that people understand well. Now, that's fine until it's not fine. And for me, this is what I mean by there's not going to be a stroke of a pen revaluation. I think one of you used that phrase. That is absolutely not what I'm suggesting. There's no such thing. We're not in that world. There's no way that's going to happen. But if sufficient concern is put into the market about, well, where's mine, then that creates a situation where people want to chase certainty. The same way people will queue up outside Northern Rock to get their cash out. People will go, wait a minute, hold on, where's mine? And then that's how you get a change in price discoveries, because people move across from financial gold to fully not even fully allocated, but gold free of custodial risk.
Speaking of that, Ned, I know that your £1 billion or so gold and silver fund at Jupiter buys gold and silver, physical metal. How do you guard against that allocation risk, the actual physical custodial risk?
Well, I mean, it's impossible to do it perfectly inside a fund product. There is no way of doing, physical gold really. But silver's a little different for me because I think it's an investment versus physical gold for me is not. It's disinvesting. You're actually removing yourself. So I think physical gold's more important in that way, how you do it. But the answer is you have a whole series within the kind of fund structure that I run. You have a whole series of different options on the screen that you can use from XAU, from foreign exchange gold, which is really pure promise of gold from a bank, all the way through to your ETPs, and then the things that I use, which are bullion trusts, the Sprott products. I prefer those because the environment where it matters, if we describe that as being uncontrolled market conditions, where it's a way of describing, the moment where people start to get worried. The clause that Sprott can deploy is effectively gating physical redemptions. So the large financial institutions that are effectively short cannot go in and openly raid what available physical there is in those products, or at least they shouldn't be able to, in theory. That is not the case with exchange traded products, where they have no such clause. They are effectively what they should be, which is exchange traded products that are designed for ease of use. So it's all about saying that ease of use on one hand versus pristine collateral on the other hand. In my opinion, that's oil and water, and they shouldn't even be in the same sentence, let alone in the same product. So for me, I just want to go as far as I can towards physical in your pocket, which obviously in a fund is not possible, and as far away as possible from the promise of it.
Yep.
Then you're sort of saying to people that your fund has non-pristine collateral in it, which is a bit of a strange way to.
No, I didn't say that. No, I didn't say that.
And stuff. You're sort of saying that second-tier assets and second-tier way of holding gold. You prefer the trust, but you also own the other things, the ETPs and so forth.
No, I don't own the ETPs, Charlie.
What do you have?
Well, we own the Sprott vehicle.
You've only got the Sprott products, have you?
Yeah.
And they're somehow superior.
Well, they're superior because they're in uncontrolled market conditions. The Sprott have the right to gate physical redemption. So rather than uncontrolled market conditions, we have the right to close the product and pay you back in dollars, which is the standard uncontrolled market clause within ETPs. In the Sprott products, it's not that. It's we can stop physical redemptions. Because if you think about it, what we're talking about here is a situation in both ETPs and Sprott products where effectively institutions that are very short are going, okay, I need the physical. Now, they can access whatever they like. They can access ETPs, they can access Sprott, they can access wherever they can get the physical, they're going to go and try and get it. The difference with the Sprott products is in that environment where you start to see substantial redemptions of physical, they have the right to go hands off. So for me, that's better. I mean, if you.
So
But some people would say the opposite. They'd say,
right.
"Oh God, they're gating my redemption." A lot
Sure,
of criticize
absolutely. If you can argue the toss that why that's the case, then go for it.
But Ned, if the gold is there, why would Sprott need or want to stop redemptions? Just deliver.
Because the amount of physical in those vehicles versus the amount the big banks are short is uncomfortably small. So when you're desperately seeking the pristine collateral to pay out your over-the-counter customers, I'm not comfortable with that being an open-ended rating situation. So I mean, hopefully that makes sense.
I mean, my understanding is that these Sprott products they cannot lend the gold out, right? So if that's the case, and someone owns units of these bullion trusts, then should they not be entitled to the gold?
Yes, and they are entitled to it. But we're talking about we're talking about a bank-run environment. I'm trying to protect against a bank-run environment, Peter, here, as best I can. And if that bank-run environment occurs, then the people who are short, which is not Sprott, are motivated to find the physical wherever they can get it. Now, there's no reason to expect that they wouldn't want to use the deliverable function of those products the same way that as APs, authorized participants of the ETPs, they can do that in those. So it's simply a case of, is there some way in which that can be stopped? And as Charlie said, if you consider that to be a bad thing, that was is a possibility, then fair enough. Don't do it.
Okay, I'm trying to understand. So you've got someone who's largely short gold, may need to fill that position. They would go out and buy the Sprott Bullion Trust and then take delivery. Is that
Yeah.
what we're saying? Okay, so if they did that, but Sprott has the gold, how does that
Yes.
compromise the other holders of that Bullion Trust that are not asking for delivery? I mean,
Yeah.
right?
I understand where you're going with this, and the
Right.
truth is, for an individual, it's probably not as much of a concern. But I'm a very large shareholder of the Sprott products,
Okay.
and in terms of my role and talking to people, I don't want the products to shrink radically. That is not a great thing for me. You might say, oh, it's still 1 for 1. The answer is no, 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 no. I don't want that happening at all. It's more also about the philosophy of it. Is it structured? Understanding this problem? And the answer is yes, it is. With the Sprott products, it is structured understanding this problem. And so for me, you are right. So what if it goes down 80% in size and you own
Exactly.
80% of the outstanding shares? It's not ideal. I don't really want to be having to explain that. I'd far rather when it goes down 15% in size because there's a whole bunch of raiding going on, that Sprott turn around and go, okay, for now we're going no, 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 no. Because the truth is, and whatever Charlie says, he's welcome to argue back, people don't own Sprott to have delivery. That's not what people use it for. It's important that it's there, but that's not why people own it. So the idea that for a short period they might say you can't take delivery, that is not going to upset owners of Sprott, in my opinion.
Yeah, well, Spock's done very well out of sort of bigging up this point that the whole system's slightly dishonest and so on. I mean, you either believe in the honesty and the integrity of the system or you don't. And
Yes, you do, exactly.
no,
That's true.
you don't and you never have. I
No,
do.
no, that's
Gentlemen,
true.
I know lots of people in the gold market, and I just think they're all good people. And
Yeah, I'm not.
and so
It's not about casting aspersions
repeat
on
the
individuals,
nonsense.
Charlie. It's not about casting aspersions on individuals, but it is about recognizing that the system post 1980 structured everything in order to be massively short physical gold. That's how the whole damn thing's been built, Charlie. That's how we got where we are. The entire
But the counter
derivative,
argument then,
the
there is a
entire
counter to
derivative
that.
laden nightmare has been constructed on the enormous growth in
Yes.
OTC and unallocated and faux gold. I mean, it just is how it is.
The derivatives markets have grown in every single asset class,
Yes,
including
they have.
right. And so that is a financial concern generally because too much leverage in the system does lead to risk. I totally get that. But the banks will all tell you that all their short positions are offsetting customer longs.
They'll
Gents,
tell you whatever they like, but they can't show that.
gentlemen, in the last 10 or 15 minutes, I'm going to ask for your views on silver, poor man's gold, and maybe the role of India and China in silver. And then I've got a couple of questions live from our audience and encourage anybody else that would like to ask a question. I'm going to read those out shortly. But maybe before we get there, Peter, could you start on silver, poor man's gold? What's the outlook? What matters in the next year or so?
Oh, well, my outlook is we could probably see $40 or north of $40 this year. I think our odds of seeing this all-time high of $50 taken out again, in my view, will likely happen at some point next year, given the momentum that we have. And I think beyond that, ultimately much higher for multiple reasons. It's vastly undervalued versus gold. In my book, I talk about, my target is ultimately $300. I'm not saying it would go there and stay there, but I'm saying that in some kind of a mania phase, we could see something like that. And I have multiple indicators that have, it's funny because when I did the research, I said, let's see where silver could ultimately go. And I looked at different indicators based on history. Of course, you have to make assumptions because you have inputs in these indicators, and one of them is the gold price. Other things are things like average U.S. House price, things like the level of the Dow or the S&P. And each time it was pointing me to somewhere in the range of about $300. And this is, again, at a peak scenario. So I think ultimately it could go there. And funny enough, since this was published 3 years ago, since then I'm hearing who I consider to be respected analysts starting to say $500 silver is, at some point likely to happen. So basically, much higher from here. It's got such a high utility as a metal. It's still almost half of it is consumed or used as money in some way in terms of investment demand. And if I like to lump silverware and jewelry in there, and so I'd say about half of it is still some form of investment demand. So I think all of these inputs suggest much higher silver prices.
Ned, what do you think?
So I think that you mentioned India. I think that's very interesting. The amount of silver that's going into India on a consistent basis is just absolutely amazing. And potentially with a big move, some of that might come back because if people see a big return very quickly, then they might sell some of their jewelry. But I tend to think that would be more than offset by the growth in investment demand in Western markets, which is zero at the moment. And nowadays, Western investors are like demented chickens at a keyboard. Things start going up and they just get completely overexcited. So I think that the most important factor here really is the arrival at some point of long only or some leveraged but Western investors. I mean, it's clear that the banks, sell side, the research specialists state that by 2030 the silver will be 120% offside on a supply demand basis. That is incredible. I mean, that is just so much worse or better if you're long than anything else, that there's going to come a point where the investment community recognize this and want to get long. So the fact that the fundamentals look so good already does suggest that the price can go a lot higher. I mean, for me, all the price action in the last 12 months in gold has been trend following in futures. I think it's quite obvious that's what's going on, and I think that's happening now in silver, according to the CTA guys, the big people that look at this. That's starting in silver. So yes, I have some fancy upside targets in silver, but I'm not going to put a number on it.
Ned, while I've got you, Jack Ryan from Bloomberg News says thank you for the comments, and he asked you specifically for transparency in the local London market. What is the most important data?
Well, I think turnover statistics. We need a breakdown as well. What are we talking about here? Are we? It's XAU trading, allocated, unallocated. Break it down. It's something which people have asked for decades, and so far we are yet to get it.
Okay. Robert, a question for you from Jack at Bloomberg is, could you speak about China's ambition to internationalize the SGE and the motivations for doing so? Has there been any evidence that they're considering adding vaults in Dubai and London?
Yeah, I think I hopefully answered this before. I think that China is trying to use gold to become an international hub. And obviously moving to Hong Kong and starting local contracts also. And they're using gold to bolster the renminbi and wanting to become an international hub by opening up the SGE and opening up the SHFE domestically as well. The other thing I just wanted to mention was we were talking about gold and silver. I'm extremely friendly to silver long term. I don't believe in gold silver ratio. I believe that if you want to buy silver, just go long silver, and you could also go long gold too. I believe that gold safe haven asset has really come in the last 2 years. And that's what also changed a bit of the gold silver ratio. But I think that just helps silver going up with gold. But silver has its own dynamics. I mean, Metal Focus says that this will be the 5th year running of a deficit. So, I mean, where gold doesn't have much of an industrial use, silver obviously has an investment and an industrial use. And I think if we also look at TD did a bunch of free floating stock and talk about lack of transparency. I agree with Ned on that. I mean, the question is how much true free floating stock is available because a lot of the silver is allocated into ETFs, ETPs. So wasn't a topic of this conversation, but I think platinum is 10 times worse. There is no transparency in LPPM, and that's why lease rates are like minus 15%, and we're in major backwardation because there's a total unknown. And I started getting friendly and announcing on my LinkedIn that in the low 900s about platinum and the lack of transparency there. And I think that's much more concerning to me than the gold right now.
Interesting. I actually ran into a friend who's corporate development at Sibanye-Stillwater, which produced a lot of platinum and palladium yesterday in London, and he explained that the latest buyers of platinum are Chinese retail, and they're buying it because gold's gone up a lot, and they're buying what they think might be the next thing. I guess they're trying to defend against renminbi weakness.
Yeah, when I grew up, when we went to buy wedding rings, the platinum was much more expensive, so we went to white gold.
Yeah.
I think that's what we're seeing in China right now. I think there was like 11 and 12 tons in April and May, which are the most that's been imported in years into China in platinum.
Yeah. Charlie Morris, a question from Steve Weyer. Can you compare Bitcoin to bullion as the ultimate hard currency, and the decentralized nature of Bitcoin versus the fact that central banks control a lot of gold?
Yeah. Thank you for the question. And I was just going to, if I could add to the last answer from Robert, one of the reasons why silver's been held back in recent years is because of Bitcoin crypto. I'm sure of that. The sort of the Twitter noise, for example, where have all the silver bugs gone? There's and there's a complete lack of young silver bugs. So just to park that thought, and that sort of brings us on to Bitcoin, which has obviously become a big deal. I think that our numbers approximate, using the World Gold Council data, gold turns over $150 billion in physical and financial gold, as Ned would call it. And that's a very, very liquid asset. Bitcoin, very hard to tell. But let's say it's a quarter to a third of that, something like that. You've got these two enormous, the two most liquid physical assets, alternative assets in the world, and they are naturally counter-cyclical, which is fantastic. So you'll typically see on a big Bitcoin day a soft gold day and vice versa. And, I think that you could say that Bitcoin is roughly worth 2 trillion, gold's 25 or something trillion. And there is this idea of a catch-up trade. Now, the Bitcoin maxis, I think, are as mad as the extreme gold bugs. So I've been the middle on both camps, which is a very difficult, awkward place to be because no one likes me, but that's fine. I can take that. But the Bitcoin maxis think that gold's toast and it's old school and it's pointless, and it doesn't go down the phone wires and that sort of thing. And there's no ledger. I'm sure Ned would love a really good ledger in the gold market, like a lovely blockchain telling you everything you ever need to know about where every bar was. It doesn't have that, but of course, we're getting that with tokenized gold and that sort of thing. So maybe we'll have much more information in the future. I would hope. But the other point I'd make about these two assets, and I was writing about this morning, the volatility of gold is going up. It's up a couple of points this year because it's having fun, and the volatility of Bitcoin's coming down. If you think the volatility of Bitcoin was over 100% 10 years ago, and is now coming sub 40%, this is, never the regulators will tell you how volatile it is. It really isn't. It's only about, it's not much more than silver. It's sort of copper, silver, oil territory. It's not that big a deal, and nothing like it once was. So that is telling you the increased liquidity and the falling volatility and the bigger adoption by institutions is telling you that Bitcoin is on the up. But I'm sure most of us here would agree that the most central banks aren't even looking at it. I mean, let alone institutional investors. I know there'll be some, El Salvador and stuff, but the serious ones, and it's nowhere near. So it's taken gold a long time from the 1970s to get back to its status. I think it's important to recognize that the gold bull market we're in has got nothing to do with policy. No one in Basel or anywhere else said buy gold to the central banks. They made their own decisions. They came to their own conclusion that this is indeed pristine collateral. And I think it will take them donkey's years to figure that out for Bitcoin, but it's on the up.
Fascinating. We do have other questions, but we're actually out of time. Can I ask each of you just go around the table here and ask you to maybe give us your final comments on the subject of the day, Trump versus gold. What might we wake up and hear about in the coming days, weeks, months of the Trump administration, and what will be the impact of these important events for the gold and the outlook for precious metals? Robert, maybe I could start with you.
I just think that every single day, you want to own volatility, 4-year volatility, because whatever he says on one day, it takes back the next day. And that global uncertainty, we mentioned the ECB came out with, 20% holding in gold, number 2 versus number 3 now, only behind the dollar. But also the Swiss National Bank, which is one of the most conservative central banks in the world, came out with a major warning on economic uncertainty and geopolitical, and also stressed that UBS, the biggest bank, needs to shore up its balance sheet. So I think it's not just the Trump administration, it's globally that people are looking at gold, and therefore I think that gold will continue to go higher, and with that it'll clearly bring silver up.
Thank you. Peter, what do you think?
I think that if you see, I think people are starting to clue in, and to Robert's point, it's the uncertainty and the concerns about inflation. We've seen stats recently. I think this was University of Michigan that puts out this kind of work, showed that the 1-year outlook for inflation had just leaped in the last few months to something like 6.5% over the next year. Just went absolutely skyrocket back to levels that it hadn't seen since 1983. And I think this is why you're seeing people start to wake up to precious metals, and why you've got places like Costco and Walmart, selling this very, very handsomely. And Costco was doing something like $1.2 billion worth of precious metal sales a year. So people are starting to pay attention. It's starting to happen. It's true. I mean, what I'm hearing from bullion dealers is they themselves, at least, it seems a little bit sort of, maybe it doesn't kind of dovetail all that well, but bullion dealers are telling me that they're actually buying considerably more than they are selling. Because the prices are so high, maybe some people need to unload, and economics are difficult. But I have to think that it's ultimately retail investors that are buying at places like Costco. So on the one hand, the demand does seem to be there. People do seem to be waking up to these concerns.
Thank you, Charlie.
Yeah, it's been a great discussion. I would just finish off by saying that I think that the central banks are doing a good job of increasing their reserves. The institutional investors are underweight gold, and massively so. Their holdings aren't particularly bigger than they were, 15 years ago, when they got a taste of what a gold bull market looks like. I think that private wealth is massively underweight gold, and I think it's retail who's probably, on the case. And so if you just think over the next 10 years, the case for gold's only going to grow with the sort of policies that are going to come out of Trump and elsewhere. I mean, just look what happened in England today with the Bank of England. The pound is fallen and the gilt yields are up because of a policy vote to spend a little bit more money than they had planned. And this is just going to keep on coming. No one's, where's Paul Volcker? He's nowhere to be seen. And there's no saver, there's no Millet anywhere. And so you put that into the mix, too much debt. The forces are for bull market in gold, silver, and everything else.
Thank you, Charlie. Agree on the excellent discussion. Ned, bring us home, buddy. What are we thinking about for gold and silver in the next year or so?
And Trump. So look, I would take issue with the idea we've been in a bull market. I think that only started in Q4 last year. You adjust the dollar gold price for inflation. We only got through the high from 1980 Q4 last year. So I think that treasuries have had it on gold. This is why people talk about the gold price because of course that's a laughably stupid idea in and of itself. The gold price. I mean, it's gold against dollars, and dollars or treasuries have had it on gold since 1980, but now they don't. We're back. We're back in the old paradigm where gold is the risk-free, not treasuries. So that's the number one most important observation, which is the 44 years of treasuries having it on gold is done. The financial system's not at all aware of this and not ready for it, and is not positioned for it. Central banks are. They know what's going on, and they are well positioned for the situation. When it comes to Trump, listen to what he says. You know, he was selling gold shoes. He has a guy who gilds the White House, so everywhere he stands, he has gold behind him. He's offered a gold card. He's talking about a golden dome. Frankly, I have a list of about 20 things, and I'm not going to bore you with every single one because that would be taking it too far, but you can go and do the research yourself. He talks about gold all the time, and he tweeted a few weeks ago, this is the key, he who has the gold makes the rules. And that has always been the case. It was the case at Bretton Woods, where the US had all the gold, and they called everybody over to discuss the fact that they had all the gold. And the rules will always be made by the institutions or the governments that are squatting the gold reserves. So look, I think that what I said before about watch out for the end of the Bretton Woods system, as in US gold reserves being marked to market, I think that's one of two moves. The second one would be to then go and reveal the paper gold market to the public and to the investment public. And then I think you can see an acceleration towards the historic kind of reset where gold extinguishes the debt in the system. We go again. But be under no illusion, this benefits the state more than anyone. You know what I'm mentioning here. This is absolutely the move that the state wants to do because it would give it yet more control and power over the public if that happened. But yeah, I think that Trump, listen to what he says. You know, I know it's hard to do it, but I think there's more going on probably than the top line may suggest.
Fascinating. Thank you, Ned, Peter, Charlie, and Robert, for a really excellent discussion today. I certainly don't change my own views. About 130% of the Catt family wealth is in gold and silver shares as a result of the conversation. I'm looking forward to a nice summer and some unpredictable twists and turns out of Trump. And maybe the last word will come from Xi Jinping, who, if he who has the gold wins, and I suspect that China has more than anyone. So he'll tell us when he's good and ready. Thank you all. I wish you a very good summer and look forward to the next discussion.
Thank you.
Simon. Pleasure.